You have Patrick Findaro here, co-founder at Vetted Biz. Brett Keynes has joined us, co-founder and CEO of Lumos. He previously served as the CFO of the largest SBA lender. He took them from the initial stages, inception, up to the IPO of Live Oak Bank. Thanks so much for joining today, Brett.
Yeah, thank you so much for having me, Patrick. Really glad to be here.
I don't want to put you on the spot, but about how many billion of SBA loans have you kind of been involved with from Live Oak as well as Lumos? Any idea?
Oh my goodness. No idea. I mean, it's definitely double digit billions. I don't know if it reaches triple digit billions, but we'll say it's getting close to that.
Okay.
Just because it sounds impressive,
Prior to the call, and we recently launched our partnership where people looking to get funding can go through our tool on the website, and Lumos powers that from the back end. But going through, the plethora of data that you guys have analyzed on the SBA loan side from your time at Lumos as well as Live Oak, it's just, there's no one, it seems like, that's even close where you and your team are at right now in this niche.
Yeah, thank you for that. And I mean, sticking with billions, there really are more than a billion data points that we analyze related to small business lending, small business loan performance. So it's a very robust data set that we have, that we've curated, that we've cleaned. And it's ours, so we think highly of it, of course. But I think we can say with confidence that it is a data set that we believe is unmatched kind of in the industry. The links we've gone to merge different data sets, overlay economic data, overlay census data, along with that small business data. So it's a pretty robust data set for sure.
What are some items that banks oftentimes overlook? And there's some lenders where it's for every 4 SBA loans, one defaults. So they're obviously not doing something right. What are some data points that they really need to be looking at for underwriting these loans?
I think a lot of times banks they'll find what works for them, and they'll stick with that mold, and they'll apply it broadly, and in a lot of ways that may not make sense or be applicable. Or conversely, they'll have one bad experience and then they'll stop doing that forever. And it's no, that one bad experience isn't the case for the other 5,000 experiences you could have. So with data, and in both of those, you can certainly expand, your small business lending activities, but then also realize in a timely way where you may be focusing that's not going to work out. Because you don't want 1 in 4 loans defaulting. You don't want one in 40 defaulting. What we do, we look at different features in our model. So we have over 3,000 different scorecards that we look at when we're analyzing a loan. This kind of gets into some more of our predictive models. We put our features into different buckets. We look at business factors, economic factors, and then credit factors. So business factors will include things like the industry that it's in, the type of business it is, the ownership structure. Economic factors are going to look at what's going on in that area, what are inflation rates, labor participation rates, and then credit factors, which are more in line with the owners of the business. What credit factors you're looking at. And I think a lot of times banks will just focus on those credit factors. Somebody starting a business and they want to see, how they've done paying their telephone bill. And those, it's an important piece. I'm not saying it's not. It's an important piece, but there's so much more.
But they could, someone that's been successful in a prior life could be swooed into some franchise business model that's half-baked. And
exactly,
no matter how successful they were in the past, if they selected a business model that doesn't make financial sense.
Yes.
There's there's some franchises that also default more loans than are paid in full. There's not many of them. Maybe there's 10 out of thousands, but there's a few notable examples where the model doesn't work.
You're exactly right. And conversely to that, somebody that's going to be a great operator of the franchises in a great location makes complete sense to do it. But 10 years ago, they've got a bad blip on their credit report. And the bank says, "Oh, we can't do that. Look what happened 10 years ago." And it's like, no, this is gonna be fine. Look at all these things in favor of it. So yeah. It works. It's both sides.
And I imagine like it might be a little different for SBA loans versus some conventional loans because of the personal guarantee that people put forth for that 504 and 7A.
Yeah, I think in both cases, well, with SBA loans, first of all, there's kind of the test for credit elsewhere. Is reasonable terms, credit on reasonable terms available elsewhere? If not, you go the SBA path. But it does come with those personal guarantees and conventional lending as well. So starting a business, starting a franchise, you got to believe in the future of that. You're putting a lot on the line for sure.
And Brett, why did you go from being a CFO of a publicly traded company, lending, to going all in on data at Lumos? And how did your experience influence you to start Lumos?
That's a lot. I think there's kind of three reasons behind that. So at Live Oak, I was there, from the very early days. We were organizing to become a bank when I started. And I think that's kind of the beginning of what led to where on this journey to Lumos and where it is today. But being part of that organizing team and the folks that were doing that, who had some history together and had definitely been in banking for a very long time, seeing their passion and energy for what they were doing, what we were going to do, it was really infectious. It was inspiring, and it was a good feeling. And you knew on the other side, if it all came together, you're going to do, great things for small businesses. So there's that, a desire to recapture that feeling, 15 years later, in another kind of startup mindset. But also along the way, and even from the early days, I sort of gravitated toward this data path. And within banking, bankings have their core systems, and there's standard reports that come out of those core systems. And most of those reports are geared toward helping a bank satisfy certain regulatory conditions. They're kind of the must-have reports that get banks through the must-do stuff. Most of what you get out of those core systems from a standardized report standpoint isn't really useful for decision-making or building a strategic path where you want to focus. I just started pulling a lot of just raw data from the core system and then transforming in a way that was more useful for business insight or business intelligence. After I became CFO, at the beginning of 2011. One of the first new positions I hired was a person to focus on data analytics. That was actually Steve
ahead of the curve.
Yeah. I mean, that's so strange for banking, especially way back then. So that was Steven. Steven is actually one of the co-founders here at Lumos as well. But he really built out that data analytics function, creating data insights, just views into the business. We had that were just by far years ahead of where banking was at the time, and seeing the power of that, and knowing a lot of banks didn't have internal resources for that type of work. So that combined with that entrepreneurial feeling of starting a new thing, definitely learned that from Chip, our CEO at Live Oak, really focused on that entrepreneurial spirit. Just taking that, Lumos just became kind of the logical next step to just sort of recapture that and make this type of data and intelligence available more broadly to banks.
Brett, when did you join Live Oak? Was it 2008?
Actually 2007, and then we got a charter in 2008. Yeah.
Okay. Since the time you've been at Live Oak and now Lumos, how has the SBA lending market changed, and even conventional lending?
It's changed a lot. It's weird. It's changed a lot, but sometimes it feels like it changes slowly. I think for many years, SBA lending was there was a verbal push for banks to do smaller dollar transactions, and I think that fits very well in the franchise world, kind of those 6-figure loan amounts versus, the 7-figure loan amounts. So it was a push to do more smaller dollar lending. And I think one of the biggest changes recently with SBA is they're putting rules around small dollar. I shouldn't say rules around. They're putting in rules that better make small dollar lending more possible for SBA lenders. And that's
where they can profit from it. Because talking to a lot of banks, like it just wasn't they didn't do it because they couldn't figure out a way to make money from it.
It was very inefficient. You're exactly right. So creating those efficiencies and SBA making some changes to the program that allows for that is certainly a positive change, especially as it relates to franchise lending, franchise funding. I think that's a big recent one. Probably to answer the conventional question part, I really think both of those probably work together in the sense that over the years, especially in the late teens, really strong economy, making a good credit decision was a lot easier, at that time. And so you have kind of this ebb and flow of like, when does an SBA loan make sense? When does a conventional loan make sense? I think banks were a lot more willing to go the conventional route versus SBA because economy was so good. So you had the kind of this ebb and flow of what belonged in SBA, what belonged in conventional. Also, the rate situation, rates were low, deposits, banks were not paying a lot for deposits. So they were offering, these great low rates, yes, to these, small business loans. There was a lot of competition for rates. And, now we're kind of seeing all that sort of up in, we're not in a place of cheap funding sources for banks anymore. So that on both SBA and conventional side changes the dynamics a lot. So it's, and what I think sometimes can be viewed as sort of a sleepy industry, there's dynamics constantly going on kind of that you don't see. So there's a lot of change for something that can sometimes feel slow.
Yeah, and I can imagine for franchisees that were funding like 5 years back, like getting a 5%, 6% rate wasn't out of questions, where now, know better than me, is it like 10, 11%?
You're going to be up there, yeah, for sure.
Yeah. So that makes it that much more important on whether it's a new franchise you're opening from zero ground up, or if it's a franchise acquisition, that there's a nice buffer for that debt servicing.
Yeah, 100%, yeah.
And how have you seen specifically franchise funding? Because I know at your time at Live Oak, it was a strong minority, and together even at Lumos. But how do you see the franchise funding space evolving? And I know you have different data partnerships with Fran Data. We're collaborating together as well at Vetted Biz. But love to hear what you guys are doing on the franchise funding side to help banks lend more to franchisees.
Yeah, I think it probably gets back to that data piece. Great thing about franchise lending is there's a lot of data available that you can use to make your next good decision. Lumos, we're happy to be playing a part kind of in that path to a loan for a franchise. Making data available, and as you said, we've done that through some different data partnerships. But you're right, when at Live Oak, at least when I was there, franchise, it wasn't initially what we focused on. We had industry focus and eventually got into franchise lending a few years before I left. But I see more and more banks interested in franchise lending. And, in some ways, there's sort of almost like a built-in pipeline when you start looking into franchise lending. There's a lot of people just kind of waiting on that franchise to become available. So I think that's really helpful for banks. And then just living in a time period where data is becoming more easily consumable helps banks to kind of more easily take that step into franchise lending. So I don't think I think it's expanding at a quicker clip, than it has, historically.
I could also see, the other way, and it's amazing that it's expanding, but at the same time, there are some like pretty bad franchises where some of them were able to get loans for like 3 years. And I would imagine with Lumos and the banks that are your customers, like doesn't make sense to lend after just a quarter. They're not going to go on like 3 years lending to some franchise business that's closing month over month, year over year units.
You're exactly right. So yeah, that unit performance, new units, closed units, transition units, All of that is really important when you're making that decision, but like you said, sometimes you don't know that until you're well into it. So, I think in those early years, focusing on other dynamics becomes increasingly important, until you have, some history where, unit trends, growth rate of the franchise broadly, where those things start to make more sense for some of these startup or new franchises.
And I imagine even like at the bank, there's, conflicting interests where you have the credit officer that's, more focused on the default rate, and then the business developer that's has great relationships with this up and coming franchise, and they're just trying to get the applications through.
Yeah, no, you're exactly right. A lot of what we often say, when we're speaking directly to a business development officer at a bank, as a salesperson, their first sale is to their credit officer. Yeah. So a lot of what we provide is helping a lender, a banker, a business development officer within a bank have that data to take to their credit group and say, this is why this makes sense for us. And we try to make that as easy and as efficient as possible for those BDOs.
And I imagine the credit officers are also using your data. So there's not a bias where it's just used for, the sell side rather than the...
Yeah. Well, yeah, credit folks love data. And, once, in a sense, the BDO makes the loan, and then the credit department lives with that decision for a long time. So hopefully they live with that decision for a long time and it doesn't go away too quickly. But a lot of the data that we provide helps kind of with that ongoing understanding of performance, in an industry, or performance by a franchise that can continually inform the credit folks, kind of the status of the portfolio.
Brett, we have prospective franchisees, owners of franchise systems, vendors, all dialed in. Can you think of any of your analytics advisory services that might be of interest to those folks?
Yeah, I would say if you're looking at a franchise and you're not set on one in particular, consuming the data, the kind of what we've curated, but looking at what the options are, taking a methodical approach to your decision and what you choose to do, and kind of having data, historical performance as the backing for that is an important step. Anybody that wants to reach out, happy to do a screen share, show some of the stuff that we have, and kind of help along, that path.
Thanks for that, Brett. What would you say is like a yellow versus a red flag that franchise executives, prospective franchisees should be thinking about when you look at, charged off to paid in full ratio? Or I guess what ratio would you find most helpful as a prospective franchisee?
It really depends. I think a lot of it depends on where you're located. What is the saturation in that market already? A great franchise in one area may not translate into a great franchise in another area. So I really think it's a case by case basis. A lot of the predictive models that we built, the factors that influence, they're nonlinear basically. So depending on the series of factors, one factor could have more or less influence than another factor. Just given the broad spectrum of characteristics. So there's a lot to consider. I don't know that I would necessarily say there's a single red flag. I mean,
sure.
Probably what you mentioned earlier is the big one about, for something that has a little more history, kind of those unit trends, what's been going on with new openings, close, transition. For franchising, I think that's a very, very important one. But I would also say that's probably the first step, and then there's other steps after that.
Yeah, it does really depend, because the transition number, if it's an established system like Wendy's, Burger King, that's healthy that it's high. There's transactions, private equity investors are coming in and out.
Yes.
It's a fluid market. Probably the EBITDA multiple will be higher because it's an asset that trades. Where if the franchise just opened up like 3 years ago and a third of the people are getting out, you want to see people getting out at the 5 to 10 year mark, or maybe longer, but usually people aren't getting out in the first 5 years.
Yes.
When they're investing in a franchise.
You're exactly right. Yeah.
Brett, how can Lumos kind of help our clients and the website users at Vetted Biz in terms of finding the right lender? Like there's different ways that I guess you can match them to lenders in your database.
Yes. So the way we work best together to help franchises is, thinking of Lumos and that data and the metrics we provide around the franchise opportunity, providing that to a bank to help them more quickly identify, this is something we're interested in. Fortunately, the team at Lumos, we're all bankers by background. So kind of, translating the need in a way that is easily consumable for banks, kind of the banks and the network that we work with, knowing what they would like to see to make a quick decision. I think it's where we play a great role, just making that connection.
Well said, Brett. And then tell me a little bit about what you see the future in the coming years. A lot of buzz with AI. What are you seeing with fintech, analytics, and how is Lumos kind of staying ahead of the curve?
I'm really excited about all of that, especially the AI, the machine learning. I think it can be a real game changer for lending. I think historically, banks can be a slower to adopt some of the newer cutting edge technology. And that's understandable. It's a highly, regulated industry, sort of some of the fintech middle kind of sitting in between businesses. And Lumos is one of those. We've leaned into natural language processing, large language models. We've leaned into machine learning and predictive modeling. Everything that we do, we put through model validation. We have folks here that when we were working at a bank, we sat on model risk management committees. We know what is needed from a regulatory standpoint. We have a 50-point MRM checklist that all of our models go through. What we develop with banking as the end user in mind. But the driving force is how do we get more capital into the hands of small businesses, into the hands of folks that want to start a franchise. So that's the goal. And we're trying to make it as easy as possible for banks. So we're really excited about what AI can do, mainly from the standpoint of the efficiencies it can create. Something that, used to take a person 4 hours. If we can use predictive models and large language models to turn that 4 hours into almost instantaneous, like 1 minute, that's just more deals that person can get through rather than spending time on stuff that can be automated. So we're really, really excited about where everything is currently from a technology standpoint and just the opportunities that are out there, and excited to work with banks on that, and excited to enable capital or make it more easily for capital to get into the hands of these small businesses.
Yeah, it sounds like the time for the business to get the capital, where maybe it was taking 3 or 4 months, is going to be really condensed down, as well as the time the applicant, the borrower, needs to allocate to the process, the lender needs to allocate to the process.
Yeah.
It seems like with Lumos, you guys are really going to be condensing that all down with the data and the tools you built on top of it.
Yeah, and the same for the work that Vetted Biz is doing. It's putting those pieces together. As you mentioned at the outset, our partnership together, putting those pieces together to bring these franchises more quickly into the fold of a bank to get their funding.
Yeah, I found there's a lot of wasted time, and a lot of folks are just like kind of moving around at different banks. So who might have been lending, a year ago is no longer lending. So
yeah,
with the data that you have, exactly who's lending what, and can get the borrower approved, much faster with someone that wants to lend to them.
Yeah, and I mean we see those trends, very quickly. I mean you can tell when there's a drop off in the activity of one lender in a certain franchise area, and where there's a spike, rather than playing or, a shotgun approach of like, who's going to look at this, like, being thoughtful and it reduces the amount of time that it takes to complete the transaction, but exactly where to go to get the deal done.
For sure. And I think that's the importance of a very large data set, especially with like a prospective franchisee that's going in an emerging brand. Maybe the bank hasn't lent to that brand in the past, but there's other brands in that same industry that they have lent to over the last quarter. So you can make an assumption that there is a good chance that your application might get through, obviously depending on your personal credit and strength of the business model.
Exactly.
Well, Brett, any concluding thoughts for our listeners?
I don't think so. I mean, certainly excited that you invited me to be on the podcast. Really enjoyed it. Really looking forward to how our partnership unfolds. And honestly, like anybody that wants to reach out, takes a look at some franchise data, please do so.
Okay. Well, Brett, I think we're definitely going to have some people following up with you on that. And then we'll also include call to action for those to go into the funding tool. There's no cost. So you can go through, it takes 3 minutes, and Lumos with their network of lenders will be able to match you, or within 48 hours tell you there isn't a match, and get back on some things maybe to adjust so you can be a better candidate for a loan.
For sure.
Awesome, Brett. Really appreciate it.
Awesome. Thank you very much.